long before credit cards existed. There was something called the Diners Club card, a card very different from today's credit cards. Before starting the video, I invite you to give us a like. By the way, if you like this kind of content, subscribe to the channel and activate the notification bell so you don't miss more content like this. Now, let's start the video. Diners Club was the first shopping card company that was similar to a credit card, but it only allowed you to eat at restaurants, and instead of paying on the spot, you paid your bill at the end of each month using that card. But it was not a credit card like the ones we know today, because you had to pay the card in full at the end of the month. Those purchase cards were the first steps of credit cards, and they were such a success that some similar cards still exist today. In fact, there are some digital banks that offer such cards. Today's credit cards are different in that instead of paying the full balance of the card each month, a person can pay only a portion of what they owe and pay the rest later. However, this is dangerous, as it can end up in a large accumulated debt on which a lot of interest will be paid. That is why it is important to teach people how to benefit from the use of credit cards instead of being enslaved by them. In its first year, 10,000 people signed up for the Diners Club card, and by 1959 the club had over 1 million members. The card company, perhaps unwittingly, created one of the biggest businesses in history. One of the easiest ways to make money is to get people into debt, that is, to lend them money and make them slaves to their debts. Many of the richest people throughout history have been bankers, and that's because all you have to do is give someone money and charge them an interest rate for the borrowed money. It's that easy and simple. You don't have to buy or sell anything. You don't have to manufacture or ship a product either. All you have to do is lend money and wait for those people you lent the money to work to pay back the loan, plus interest. And the more money you lend, the more money you make, so you want people to take out incredibly large loans like a home mortgage so that they are locked into that loan for much of their life. If the interest rate is very high, then the payment due will also be high, making the debt larger and more difficult to repay. These high-rate loans tend to trap poor people more easily than those who are better off. The cost of being poor is very high when it comes to taking out a loan, since the interest rates paid by the poor are much higher, and many times the installment of a loan ends up being almost the entire salary of the person. And in the last decades, credit cards became the perfect way to trap people by giving them credit at a very high interest rate. If you are liking the video, I invite you to give us a like and subscribe to the channel so you don't miss more content like this. The cards work with the same logic as a credit, like the one you would use to buy a house, but with daily purchases. This is because people use their cards so much that they end up accumulating giant debts that then take many years to pay off. That is, when people want to buy something but have no money, they use their credit cards. However, many times people make one purchase and then another and another until they accumulate a lot of debt. And before they know it, they have accumulated so much credit card debt that they can barely pay the interest every month. And that's exactly how credit cards make money. In the year 2020, the average American had more than 3 credit cards, with an average balance of more than $5,000 of debt on each card. And this debt is growing. Meanwhile, the credit card companies continue to make money, raking in over $176 billion in revenue in 2020 alone. But despite this dark side of credit cards, many people are credit card fanatics and have several. With a single American bank credit card, you can buy almost anything, almost anywhere. In 1966, credit cards became so popular that Bank of America began selling other banks the right to create credit cards for each bank. Finally, after the merger of several banks, Visa was created, which replaced Bank of America in the 1970s. And there began the competition between all the banks to sell their own credit cards through Visa, as is the case today. Security measures evolved, and by the 1980s, most credit cards came with a magnetic stripe and the ability to verify purchases. This opened the door for more and more banks to see the business and offer their customers their own credit cards. Let us know in the comments what you think of the video, and remember, we will be happy to read it. The growth of credit cards, along with other facts, caused household debt to start skyrocketing. Banks earned little from the interest they charge, but in most cases they were prohibited by law from raising interest rates. So they needed a way to charge people more interest for using their cards. They needed this cool new product that made people think they could buy things for free to make them a lot more money. And they succeeded for a long time to come. Credit cards were not for everyone equally. Because if you were a person with a higher risk of defaulting, such as an unemployed person with little chance of paying off your card, then you would have to pay an incredibly high interest rate. In other words, if you have a debt and the bank charges you interest, you have to pay a higher amount than you receive, but if at the time of payment you do not pay all that money, interest will be charged again on the balance. The card business grew so much that it reached the point where Citigroup, the company that owns Citibank, was one of the most profitable companies in the early 2000s. But it wouldn't end there, because the Supreme Court would pass another law. This law removed the few remaining limits, and now banks could charge whatever interest they wanted. The results rate increases that went as high as 36%, or even being able to change customers' interest rates at any time and with almost no notice. An interest rate of 36% meant that if it took you 2 years to pay off a $10,000 balance, you would end up paying the bank over $14,000, a lot of money. Evidently, some people have money to spend for such a high maintenance expense for having a simple credit card. Contrary to what one might think, a credit card company's worst nightmare is a customer who pays off their debt every month because that person has all the benefits, but pays no interest. What banks really want is to have late debtors, that is, people who can't pay their debts and therefore are late in their payments. That's because a person who only pays the minimum amount on their card instead of the full amount is going to be continually paying interest. A passive income for the bank. US credit card companies were beginning to look more like loan sharks than banks. They hired the best lawyers to write contracts full of favorable clauses that people could not understand. For example, the contracts gave the banks the power to raise interest rates whenever they wanted or put payment dates on holidays or weekends so that people could not pay on time and thus charge much more money. As we said before, many people are delighted with credit cards, but this is not only because of the purchases, but having a credit card you can also enjoy other advantages that they offer for free. One of the most useful and appreciated for those who like to travel is access to airline lounges, which allows you to live a better experience at airports. Clearly, the additional expense of this type of card is somewhat expensive compared to many others, but if you are a person who likes to travel and have these exclusive benefits, it is worth it. In addition, many cards allow you to earn points or miles, and with them you can take really great trips. Having one or several credit cards is not always a bad thing, as long as you know how to organize your expenses and pay them consciously so you don't end up paying too much interest. Besides all this, each card is different and has countless benefits, perfect for each client. You just need to know how to manage them well so you don't fall into big debts in the future. That's all in today's video. If you liked the video, leave us a comment and give us a like. By the way, subscribe to the channel by activating the notification bell so you don't miss more content like this. See you in the next video.